Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing SmartCentres stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. SmartCentres is a real estate investment trust that specializes in retail real estate, especially power centers. The company is headquartered in Ontario, Canada, and was founded in 1994. It went public in 2003 and currently trades on the TSX and the Pink Sheets. Almost all of its malls have Walmart as a tenant. It opens a new mall every 3 weeks and has developed over 50 million square feet of space. Let's get started with the model. This is a mid-cap company, 4.8 billion market cap. They're trading at $28 a share and they have 170 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they have positive and pretty consistent free cash flow each year. Net income is the profit and loss on the income statement. That's revenue minus expenses. That's also positive each year, dropping a lot in 2020. Revenue is the sales for the company. That's pretty consistent, around $700 to $800 million a year. This is the company's income statement. The top line is the revenue, the sales. Their sales are the rent and lease payments it receives from its customers at its shopping centers. Then below that is the cost of revenue. These are the expenses directly related to generating the revenue. An example is cost of labor. The difference between those two numbers is their gross profit. They had their lowest gross profit in 2020. Then below that is operating expenses. Then operating income, which was also the lowest in 2020. They paid $139 million of interest on their debt, which is the most interest they paid in the past 4 years. Then you have other income and expenses. This is usually impairments or write-offs. And the bottom line of the income statement is your net income. The main reason they had low net income in 2020 when compared to prior years was this negative $197 million in other income and expenses. I would focus on operating income when I look at the income statement, and that's pretty consistent year to year. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. And they have very little in CapEx each year. Operating cash flow minus CapEx gives you your free cash flow. Most of their free cash flow is used to pay a dividend. They pay about $300 million of dividend payments a year. They pay a monthly dividend. You can see they also use debt to fund their business. They issued $1.8 billion of debt in 2020 and paid down about $870 million. So they added over $900 million of debt that year. They seem to add debt most years. They did pay down more debt in 2018 than they issued. They also added $220 million of capital stock in 2019. When a company adds capital stock, this increases the shares outstanding, making your shares less valuable. Let's look at the capital structure. $4.3 billion of equity, $5.2 billion of debt. They're 45% equity, 55% debt. And their net debt is $4.4 billion. Their WACC is 6.9%. And that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $8.9 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $8.1 billion. We divide that by 170 million shares. And we get a calculated stock price of $48. They're trading at $28, so they're trading at a 41% discount. It's a strong buy according to the model. Simply Wall Street values the company at $43, so they're also saying the stock is undervalued. The stock was trading about $42, $43 at its peak, and it was pretty steady for a while. The stock decreased a lot last March when the market crashed. It looks like the stock dropped to about $17, $18, but it has come up since then, but it's trading a lot lower than its pre-March highs. This company pays a monthly dividend. They've been paying 15 cents for a while. Their dividend yield is 6.6%. They pay out 418% of their net income. That's because of that large asset impairment. They pay out 106% of their free cash flow. I would focus on free cash flow payout instead of net income, especially when looking at a REIT. The top 25% of the market pays a 4.7% dividend yield. They're at 6.6%. So this company is probably in the top 10% of the market. Their industry pays a 4.7% dividend, so they're much stronger than their industry. And analysts are forecasting their dividend to stay steady at 6.6% in the next 3 years. They have a beta of 1.2, so the stock moves a little more than the market. The stock has gone up 30% in the past 52 weeks, while the S&P 500 went up 45%. The 52-week low was 18, the high was 28. And the stock is trading above its 50-day and 200-day moving average. About 500,000 shares are traded each day on this stock. Of the 170 million shares outstanding, 129 million are on float. 30% are held by institutions, and less than 1% of the shares are shorted. If you include dividends, in the past year, this stock has gone up 46%, whilst industry 32% and the market 47%. In the past 3 years, this stock has gone up 20%, which is worse than its industry of 24% and a market of 32%. In the past 5 years, this stock has gone up 15%, whilst industry went up 42% and a market 57%. In the past 5 years, their earnings decreased 9% on average, whilst industry increased 21% and the market increased 12%. In the past year, their earnings decreased 76%, its industry decreased 17%, and the market increased 6%. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have about $13,000 today. That's a 2.5% annual return. The biggest shareholder is a CEO at 10%, then BlackRock, Vanguard, RBC, and BMO. Let's look at their financial ratios. The average PE in the market is 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They're at 63.4, so investors are paying $63 for $1 of earnings. Price to sales is stock price over sales per share, they're at 6.1. Price to book is stock price over book value per share, they're at 1.1. Their return on invested capital is 4.9%. Their interest coverage ratio is 3.1, so they can cover their interest payments a little more than 3 times. ROE is 2%, and their current ratio is 0.9, so that means they can only cover 90% of their current liabilities. Their current assets are $800 million of cash and $200 million of receivables. So the company does seem to be undercapitalized. They did have $300 million of free cash flow, but negative $84 million of working capital and over $300 million of dividend payments. So they're short about $100 million. They're going to need more debt or equity financing to run their business over the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. I've done videos of 12 companies in the same industry as SmartCentres. And if SmartCentres has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. Price of stock over funds from operations per share is an important ratio when looking at a REIT. They're at 13.1, so they're at about the average. Their PE is much worse than average. Price of sales is a little worse than average. They're doing better in price to book. They're worse than average in current ratio. They have a pretty weak ROE. They're a little lower in debt than average. Their market cap is $4.8 billion. The average of all these companies when converted to Canadian dollars is $7 billion. And their dividend is much higher than average. So to summarize, I have them trading at a 41% discount. This company struggled a little bit because of coronavirus, less people shopping at malls. But I'm pretty confident this year and next year, they're going to do really well because people are itching to get back out there, go shopping, and get back to regular life as it was before coronavirus. Lots of things are opening up, so things are getting much better. I rank their free cash flows 5 out of 10, their revenue 5 out of 10, and their ratios 3 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.